There is a huge challenge around the world right now on executive compensation, especially with regards to bank leadership. Uh, I think broadly the world recognizes or feels that bank CEOs and CXOs are significantly excessively paid. And we had an opportunity in the last couple of years to actually look at what's happening around the world in terms of senior leadership compensation of banks, what the practices are, and obviously came to our own conclusions on what's the right thing to do and what may not be appropriate. If I start with the point around performance measurement, what we found is that a lot of banks around the world, leading banks, have reached a reasonable point of recognizing that when they're going to measure the financial performance, when they're going to measure the performance of the bank CEO, they can't only depend on financial performance. Because very often, many banks are sitting in certain markets where there may be some short-term financial growth, but there may be some non-financial measures that are lacking. I'll give you a simple example. For example, it's very important for banks to digitize. But if the digital journey of the bank isn't going so well, then it is likely to affect medium to long-term bank success. So that's an example of making sure that you have the right mix between financial and non-financial measurement. You also find, for example, for some of these banks or a number of banks, that another area that could be improved on is the target setting. And if the targets are set too aggressively sometimes, it leads to bad behavior. Bad behavior in banks means lending when you shouldn't lend, right? And this happens very often where the next leader finds that he or she has owned a really bad book because the previous seat leader or head of retail bank or corporate bank got carried away to lend money, not only because the shareholder wanted him or her to do it, but because there was a big bonus check or stock option sitting in the back of it. So you need to be careful as to what targets you set, especially lending targets. We found a very strange occurrence, I would say, in the way compensation is actually measured by the central banks, which was fascinating. So for example, many central banks around the world will count the compensation fully. So they'll count the fixed, they'll count the variable, and they'll also count the stock options. And that is the comprehensive package that one must count. But we found that in some countries, for example in India, where the Reserve Bank of India is, and they're making some changes now, and I think they recognize the gap, where they were predominantly focused on the fixed compensation and the variable compensation. But the reality is that most bank executives have become wealthy not on the basis of the fixed and the variable, which was in any case capped at 70% of fixed, but on the stock options, because in the Indian context, for example, the price to book value of banks has gone from 3 to 4 to 5 to 6 versus the 1.5 for a JP Morgan, for example. So I think it's very important that all central banks around the world make sure that when they count compensation, they count it comprehensively, completely, including the options. There was another lesson that we could see, one could learn, and that is the vesting period of these options, right? So what you don't want is you don't want the options to vest too quickly, and you don't want them to vest too late, right? If you vest them too quickly, that means you're having people benefit before the bank is actually benefited in certain ways, because there may be certain risk in the actions that they took in a certain year that may only show up 3 or 4 years later. So we would normally recommend is that the vesting period should start, it should start no more than, it should take around 2 to 3 years before the vesting starts, and should run for a 3 to 4 year period, so that the executive understands that, look, you know what, any benefits out of his or her decisions is the bank should not suffer in the medium term. And then lastly, I would say is the clauses around what's called malice and clawback, right? So what happens is that if somebody gets paid or somebody has been issued options, or if things go wrong, there should be an ability to kind of pull it back. The reality is that if you've already handed out the cash because the vesting period was too short, it's very hard to get cash back, right? So again, I think I would just say that you need to look at your malice and clawback clauses carefully, so that you're not in a situation where if you need to claw back money, that you are unable to do so. At the end, I'd like to add that while I recognize the importance of pay for performance and that people need to be well paid, there has to be some rationality also to it, right? And what we saw is even some of the most successful banks in the world, the compensation multiple between the lowest bank employee and the CEO was 400 to 500x. Let's for a moment assume that that's acceptable. But I've also seen banks where the multiple is 1000x, which is just, in my view, simply unfair. So again, if I was a member of the board, if I was a member of the compensation committee, I would look at these 6 or 7 areas and make sure that we get the compensation framework right.